whilst we allow everybody to connect to the call, but lovely to see so many of you here today for our session. Grab yourself a cuppa while we just wait for everybody to join before we kickstart today's session off. Thank you. Good morning, everybody. Thank you for joining us today. For those of you who don't know me, I'm Kathy Ramsey, the Partnerships Manager here at the Tourism Industry Council of South Australia. I'd like to acknowledge that I'm hosting this webinar from the lands of the Kaurna people. I'd like to acknowledge the traditional countries of the various lands where you all join us from today, and the First Nations people participating in this webinar. I pay my respects to elders, past, present, and emerging, and celebrate the diversity of First Nations people and their ongoing cultures and connections to the lands and waters of South Australia. The In Conversation series is a program undertaken monthly to keep our wonderful South Australian tourism industry and stakeholders engaged and informed. I'll introduce our speakers shortly, but just a couple of housekeeping matters first to keep everything running smoothly. Appreciate everybody to keep their microphone on mute. We have the chat function, which is at the bottom of your screen. I really encourage everybody to use the chat function for any questions. We love to make these sessions as interactive as possible, and we'll endeavour to work through those questions either throughout the session, but also allowing a bit of time for Q&A as well at the end. This session is being recorded for an ongoing resource to our members and will be distributed to you all once we conclude with an email, which includes obviously the recording and any other further resources that will get discussed today. So today's session, it's all about the current economic and financial state of South Australia. There's no doubt costs and interest rates are continuing to rise, and businesses are feeling it more than ever. Knowing where to look for information and support can be extremely difficult at times. Our latest tourism, you can't quite see it, tourism barometer report has come out, and the key findings have really highlighted that business confidence is fabulous. It's the highest it's been since December 2007, with 70% of our respondents either extremely confident or confident about their 3-month and 12-month outlook. However, the key concerns are the rising costs of doing business. We know that wages have increased, from December. We know that superannuation has increased, electricity and gas, variable interest rates, insurance premiums, as well as the inflationary impacts and all general other expenses as well. It's increasing. So I'm really lucky to be joined by a team of experts today from BankSA, who is going to guide us through some of their top tips to navigate the current market. So I'd like to welcome the team from BankSA, Pat Bustamante, Senior Economist, from Westpac Business, St George and the Bank of Melbourne, BankSA and BT. Welcome, Pat. There, he can give us a wave, so you know. Cheers, thanks, Pat. We've got Andrew Hicks, BankSA Relationship Manager, Hospitality. Andrew, if you could just give us a wave, that's great. And we've got David Brownie, Corporate Partnerships Manager, on the line as well. David, thank you. So perhaps to start off today's session, let's tell us, the three of you gentlemen, if you could just tell us a little bit about yourselves and the type of work you do. Can we kick start it off with yourself, Pat?
Yeah, thanks, Kathy. Thanks for having me on. So I'm a senior economist in the Westpac Business Economics team. So in terms of what I do, day to day, I look at economic trends, I look at data releases, and we forecast where the economy is going. And one of the big kind of shifts that have happened over the last, say, 6 months has been the increase in the cash rate. So that the RBA has been quite aggressive. You've seen the cash rate increase from 0.1% to 2.85%. And that's something that we kind of look at, forecast, and try to forecast what the impacts are on businesses and in households as well. So that's kind of what I do on a day-to-day basis. So yeah, happy to share insights.
Thanks, Pat, and we look forward to pricking your brain shortly. Andrew, a lot of you might be familiar with Andrew if you have been the Relationship Manager for Hospitality, which includes tourism as well. Andrew, hi. If you might just need to take yourself off mute.
Take off mute. There we go. Thanks, Kathy.
Right.
Yes. Andrew Hicks. I'm a 37-year banker with more tend 20 years of that involved in the hospitality sector, so hotels, accommodation, some restaurants and cafes and the like. Yeah, I've been around too long probably, but yeah, a very experienced banker.
Great. Thank you, Andrew. And David.
Yeah, you bet. Thanks, Kathy. David Brownie, Corporate Partner Manager, BankSA, been with the bank 6 years and have the absolute privilege of looking after all of BankSA's corporate partners across SANT, and obviously TechSA is one of our very important partners.
Great. Thanks, David. So we've been lucky enough, Pat has prepared a presentation for us today to talk just on that, the current economy and the financial state of South Australia. So David, from Pat, I'll hand this over for you and yeah, pass you to talk us through the session and update us on where we are at. Oh, sorry, Pat, you're on mute.
Oh, there we go.
Perfect.
So I've just started sharing my screen. Is that visible to everyone? Yep.
That's great.
That's great. Excellent. So yeah, I plan to go in terms of what I'm going to cover today. Just cover where we see the economy currently at, what the economic shocks are that are currently hitting the economy, and then where we see both the state of South Australia and the Australian economy over the next kind of year or so. So I plan to talk for about 20 minutes and then have a bit of a Q&A session at the end.
Great, thank you, Pat.
So in terms of our starting point, the economy and kind of consistent with what Kathy said, the economy is quite strong at the moment, and that's been underpinned by strong household consumption. So if you look at that chart on the left-hand side, you can see that spending on goods, which includes electronics, household furniture, clothing, footwear, all those items, that's been quite strong. So after taking an initial hit during the pandemic, it's rebounded quite strongly to grow again quite strongly over the last kind of few quarters as well. On the services side, the experience was very different. So lockdowns meant We couldn't go to our favorite restaurants. We couldn't go to our favorite hotels. So spending on services took a big hit, and indeed only recovered to be above pre-pandemic levels in the June quarter this year. And if you look on the right-hand side chart, a lot of that recovery was driven by spending on hospitality. So that includes, hotels, cafes, restaurants. Spending on recreational services has been quite strong. That includes like sporting events, going to your local zoo. But what hasn't really recovered is transport services. So that's domestic and international travel. So that's still well below pre-pandemic levels. And we're still expecting that to normalise, and that will provide a bit of strength to household consumption over the next quarter or so. So on the back of strong household demand, business conditions are sitting at around a record level at the moment. So if you exclude or ignore the pandemic volatility, which is mainly driven by lockdowns and the easing of restrictions, where we're currently at, which is about 22 index points, is higher. It's higher than any other peak in the pre-pandemic period, and that even includes the mining boom during the early 2000s. So that just gives you an indication of how strong things are. And the chart for South Australia is quite similar. So it's at a record high, which just shows how strong household demand is. And off the back of strong demand and strong business conditions, we're seeing capacity utilisation remain around a record high as well. So it hit a record high in August, and you can see that on the right-hand side, and it's been around that level ever since. And that means businesses have been investing more in machinery and equipment, and they've also been hiring more labour to meet demand. And that has seen the unemployment rate fall to 3.5%, which is the lowest rate it's been in around 50 years. And when you consider that the pre-pandemic average was about 5.5%, it's quite a remarkable result, and it shows just how strong the economy is at the moment. The other pleasing thing about the labour force is the strengths distributed across all states and territories, not just in one or two of the big states. And that even includes, that also includes South Australia, which has seen the unemployment rate fall from 5.6% pre-pandemic to about 4.3% in September. And that's actually a bit high. 4.3% is a bit high, because in April it was at in August, sorry, is at 4%. And that tick up just reflects more people joining the labour force. So we're expecting that to come down over the next few months. But it just shows the extent of the decline in unemployment and the strength in the labour market that we're seeing at the moment. So part of the story there is strong demand, but it's also on the supply side. So on the left-hand side chart, the red line, you can see net overseas migration during the pandemic actually went backwards. And that was the first time since 1946 that net overseas migration went backwards. And now it's started to recover. So we've seen pretty strong increases in particularly short-term arrivals, international students, and that will support both population and labour supply going forward. And when it comes to South Australia, on the right-hand side, you can see that overseas migration has also bounced back quite strongly in South Australia. It's not where it was pre-pandemic, but it's getting there, and we're expecting that to continue to increase going forward. And indeed, in last month's budget, the government's forecasting that net overseas migration will return to 235 people per year, which is basically where we were pre-pandemic. So we're expecting that to bounce back quite strongly, and South Australia will also benefit from that. The other interesting trend when it comes to South Australia is interstate migration, and that's the red line on the chart on the right-hand side. That's basically positive now, and that's the first time it's been positive in 30 years, since the late 1980s. So that means more people are relocating into South Australia than leaving South Australia. And one of the trends has been having a more flexible working environment. Means people can relocate to be close to their friends and family, but still work in kind of the major cities. And I live in Canberra, and I have a few friends that they did exactly that, have relocated to Adelaide, even though they continue working for a department in Canberra. So if that continues, that flexible work environment continues, you expect to see interstate migration remain positive for South Australia as well. which is another positive when it comes to labour supply. So up until now, I've told a very positive story. So conditions are strong on the back of strong demand. The labour market is very tight, with the unemployment being at its lowest rate in 50 years. But there are headwinds ahead. And one of the big ones is inflation. So our latest read on inflation was 7.3% in annual terms for the September quarter. And that was the strongest inflation read in 32 years. On the back of that, the RBA and we did as well, we revised our forecast upwards. We're now expecting inflation to peak at 8% in the December quarter, and to remain higher for longer. So we're basically not getting back to the target of 2 to 3% until 2025. And the significance of this is, if you're spending more on your essential goods and services, so electricity, on housing, it means you're spending less on non-discretionary items such as, tourism, recreational goods and services, which will slow down spending, slow down activity, and lead to a bit of a slowdown in the economy. The other impact of higher inflation is higher interest rates. So as I mentioned earlier, the RBA has embarked on a quite aggressive interest rate tightening cycle, which has seen the cash rate go from 0.1% in April to 2.85% today. We're expecting this will go to 3.85% next year, by May next year. And that's basically our view in terms of what the RBA needs to do to get inflation down. And that's a bit lower than what markets are expecting. So markets are expecting their cash rate to be at around 4% or just over by the end of next year. And in terms of economists' expectation, it kind of ranges from 2.85 to 4.5. So high inflation has meant that interest rates have increased quite rapidly, and we're expecting that to continue into next year. So with high inflation, means your debt servicing costs will increase quite significantly as well. And we're already starting to see this spike. So as an indicative, very kind of stylized scenario there, average mortgage today is about 600K, and the cash rate has increased, will most likely increase by about 300 basis points by December. That means someone with an average mortgage will pay about 14,000 more in interest expenses per year. So that's quite significant. That money has to come from somewhere, and we're expecting that'll mean a pullback in other non-essential goods and services. So on that right-hand side chart, that basically shows what the distribution would be amongst households with variable rate mortgages. So if you look at just the middle two columns to start with, so it shows that basically across all households with variable mortgages, about a quarter of those households will experience an increase in repayments of 20 to 40%. And that's with a 300 basis point increase in the cash rate. So there's potential kind of downside to this number. And then if you look at the second last column from the right-hand side, it shows that a third of these households will experience a more than 40% increase in repayment. So these are quite significant increases, and they'll start to bite within next year. So the other point which the RBA has been making quite regularly is that monetary policy works with a big lag. And one of the reasons that there's a lag when it comes to monetary policy is because you have fixed rate mortgages as well, and they're not changing when the cash rate changes. They change when they roll over from fixed to variable rates. And we're expecting a lot of these mortgages to roll over from fixed to variable over the next year. So basically about 2/3 of all households with fixed rates will roll over into variable rates over 2023. And when that happens, they'll be facing interest rates which aren't 25 or 50 basis points higher. They'll be facing interest rates which are like 3 or 3.5 percentage points higher. So quite significant increases. And I've tried to demonstrate that on the chart on the right-hand side there, which basically shows all those households that roll over from fixed to variable, they're all going to experience, basically all of them will experience an increase in mortgage repayments of more than 40%. So quite a significant increase in your kind of essential spending there. The other impact from high interest rates is on asset prices, including house prices. So since the RBA started to increase the cash rate, we've seen house prices fall across Australia by around 6%. This was mainly out of Sydney and Melbourne. So Sydney has seen a 10% fall in house prices, Melbourne's seen a 6% fall. The story's been a little different in Adelaide. So during the pandemic, there was quite a steep increase in house prices. And that reflects a bit of a catch up. So the median and the average prices in Adelaide were quite lower when you compare it to comparable capital cities such as Melbourne. And now it's basically caught up to where Melbourne was sitting. But since then, demand has continued to be quite strong. And you saw net interstate migration remains positive. And you're also seeing net overseas migration increasing. So that's all increasing demand for housing. On the supply side, the stock of dwellings that have been advertised has actually fallen. So it's actually 40% of what it's been on average over the last 4 years. So when you have an increase in demand and you have a shortfall in supply, prices have been supported. And that's why we haven't really seen a dip in the Adelaide market at the moment. In terms of the outlook, we're expecting to see a bit of a fall there in Adelaide, but not as steep as what the other major capital cities are expected to record, particularly Sydney, which saw such a large run up during the pandemic. So from peak to trough, we're expecting prices to fall by about 15%. So we're around halfway through that cycle at the moment, and that will just continue as interest rates continue to increase. And as the current increases are passed on to households with a lag as well. And the significance of this is if the value of your housing takes a hit, consumers feel like they're less wealthy, they're less inclined to spend, which will also slow down spending. So the headwinds suggest that spending will slow quite sharply in 2023. But before that happens, over the next quarter or so, we're still expecting spending on services to be quite strong. And that's because when you think about it, this year will be the first time in 3 years where families will be able to spend Christmas, New Year's, a holiday period together. So we're expecting to see services, spending on services bounce back over the next quarter or so. And you can see on the left-hand side chart there, that domestic air travel hasn't really rebounded fully to where it was pre-pandemic. So there's a bit of upside there, and that includes domestic travel for business, but also for leisure. And there's also quite a bit of upside when it comes to international tourists. So that's been, that took quite a significant hit, as you can imagine, during the pandemic with the border being shut. So pre-pandemic, tourists were spending every quarter about $18 billion in Australia. At the moment, it's closer to $10 billion. So over the summer, over the holiday period, we're expecting that to tick up, and that's going to provide a bit of upside for the economy and spending. But we're expecting this support to kind of dissipate by February or March next year. And at that time, we're expecting the headwinds of higher inflation and higher interest rates to really start to bite, and the economy to really start to slow in 2023. In fact, we're forecasting the economy to grow by just 1% in 2023, which is much lower than the 4% we're expecting for 2022. Off the back of an easing in economic activity, we're also expecting the unemployment rate to tick up to 4.5% by the end of next year. So it's looking like a pretty weak near-term outlook. I guess the one silver lining is that if we can get through the next little period and hold unemployment at that 4 to 4.5% mark, and have wages growing at about 3.5–4%, which we're expecting them to grow at the moment, we'll be in a better shape than when we were heading into the pandemic, when unemployment was sitting at around 5.5%. And wages are growing at 2–2.5%. But before we get there, there's a bit of a slowdown and a bit of pain ahead when it comes to the economy in the labour market. So that's what I was going to go through and open up for any questions
Awesome. Thanks, Pat, for sharing that insight. Much appreciated. Welcome any questions before we go over to Andrew. But Pat, one thing I sort of, and feel free to put them on the chat function. One thing I can note, Pat, is obviously, you know, in the tourism industry, a lot of, and it was probably across various industries, businesses took on more debt to get through the pandemic. And obviously we've got strong demand and strong business conditions at the moment, but like you said, that's we're gonna really hit those headwinds next year. So what are some things some businesses can be doing if wages are forecasted to increase? Demand is going to go potentially down for product. We've also got inflation increases on all other general expenditures, interest rates, insurance premiums, interest rates, electricity, gas, superannuation. What are some areas that your business should be looking at now to try and claw back and be able to face this real what's ahead of them in predominantly 2023?
Yeah, that's a good question. And one thing that we've been seeing is that, as you say, credit growth in the business sector has been quite strong, and that's been quite broad based across the SME sector and also the larger businesses. I'm just trying to remember, just to the end of the September month, business credit grew by like 14.7%, which was the strongest in like 14 years. So there's a lot of strength there. And what we have been seeing is that a lot of businesses, while they're borrowing to invest in new capacity, those that aren't investing are using excess liquidity or cash flow to pay down debt. So we're also seeing a lot of businesses pay down, and particularly in the small end of the market, a lot of the debt which they've accumulated. So they've saved up during the pandemic, they've saved up when conditions are quite strong, and now they've started to pay down some of that debt. So that's obviously something that's given interest rates are increasing and the cost of capital is going to increase. That's obviously something that if you can do, you probably should look at doing that. That'll kind of reduce your overheads quite significantly.
Yeah.
And I guess that would be the main one. We've been increasing interest rates where there is spare capital or liquidity. If you can pay down that debt, I think that makes sense to pay it down at this point in the cycle.
Yeah, perfect.
And it also leaves open kind of headroom in overdrafts and other liquidity facilities to draw down on if you want to smooth your expenditure going forward.
Yeah, and interesting you commented on in perspective to wage conditions and labour supply. We've got the lowest unemployment rate, but in our lowest unemployment rate that we've had in years here in South Australia, and in our latest barometer report, what was a really interesting note is I think 30% of businesses took on more staff, but 50% reported an increase in wages. And so that's going to be a really fundamental part of managing these expenditure moving forward.
Yeah.
I'm just going to throw to a quick question from the City of Port Lincoln. Housing is in such short supply around the country, both to buy and to rent. Do you see house prices dropping entirely to increasing interest rates? Where I live in Port Lincoln, housing prices are still rising strongly due to lack of supply and being brought by many interstate investors. Great question, Naomi. And I suppose in that information you did share with us, Pat, South Australia has received positive migration from interstate. And I think the fact that our housing market is well priced compared to some of our interstate counterparts. What does that look like moving forward, as Naomi mentioned?
Yeah, and that's something we're seeing as well, with flexible working conditions, with people essentially able to relocate and still work from out of like the major capital cities. We've also seen, prices in some regional areas increase quite significantly and hold up. And that's something that, we expect to kind of continue. So in the past, in previous cycles, where prices in your capital cities have, increased quite significantly, people always had the option to move into the regions. But now that option's been kind of diminished, and that's because like a lot of people have already taken advantage of that. So we're expecting those regional kind of prices to maybe hold up a bit. But I mean, the overall trend will be that we'll have it's essentially a correction. So prices reflect the really low interest rates. Like at the start of the year, as interest rates increase, your kind of returns on assets will come down. So we're expecting assets prices to fall, but we're expecting that to be quite orderly. Like we're not seeing any distressed sales at the moment. With the labour market so strong, we're not expecting to see like a strong pickup in distressed sales or anything like that. So we're more expecting a kind of orderly decline in house prices across Australia.
Okay, thanks for that insight, Pat, and thanks for that question, Naomi. Encourage the rest of our viewers or participants in today's session to use that chat function and utilise the expertise we have on the call today. I'm going to throw over to Andrew Hicks. He is based here in South Australia and is the relationship manager for with BankSA and Westpac, I believe, Andrew, for hospitality, including tourism. So Andrew, give us a bit of an insight specifically to South Australia. You've got many customers you deal with in South Australia. What's your temperature check on the situation currently?
Yep, sure. Thanks, Kathy. And just to clarify, so I am the BankSA brand, so we are part of the Westpac group, but yeah, we do sort of run two separate businesses in South Australia, okay. Although BankSA is the major partner here.
Thank you for that correction.
Yeah, I'm based on the Nord Parade. So BankSA, by virtue, is the largest bank in South Australia, and we're spread across the corporate business where I am, the SME business, which is the under 2 million, and then we've also got a pretty large regional and agri footprint. Yeah, we are the biggest bank in South Australia. Yeah, a few of my notes that I had to go through sort of reflect a bit about what Pat's talked about, but yeah, COVID was the most challenging period that we've all seen. I've been in banking for over 35 years, and yeah, it was by far the most challenging period I've ever been through. And for that hospitality sector in particular, with lockdowns and border closures, it was a significant impact. So yeah, and thankfully for the majority of our customers, I can't think of one that hasn't come through the other end. So thankfully everyone's been able to pull through. But that was a combination of the governments providing stimulus packages and support, and banks providing support, and sort of we've come out the back end of that now, and because of that, those lockdowns and border closures, consumers are actually pretty well cashed up, and they've been able to save money and reduce debt, and now they're in a position where now they have the freedom to get back into circulation as such, so looking to get out and travel and see the regional areas. So what we've seen over the last sort of 6 to 12 months is domestic and regional travel and tourism has been very strong, because of the lack of interstate and international alternatives, but so that's been really good, and there's been government support with travel vouchers and the like. The new Labor government has been very supportive of tourism and getting out there and trying to support the industry. We've seen we've got the race coming back in December, so the Adelaide 500 race is coming back. There's the Tour Down Under will be back in January, and then in the last week or so, we've seen announcements with regards to April for both the AFL Magic Round, or whatever they're going to call it, and also now the golf tournament. So the government and industry is very hopeful that will not only have the peak period of Mad March, but it's going to stretch out into April with those events, and that should be very, very good for our tourism sector. So we're expecting, because people are cashed up and yes, interest rates are starting to change, but we don't think they're biting too much just yet. So we think for the next 12 months or so at least that those people will still be out there supporting the regional tourism. There's now plenty of demand. It's the supply sort of part of the equation that's been probably the greatest challenge, and that's around attracting staff Pat touched on the thing about international students and travellers. So historically, hospitality's relied a lot on casuals that have worked part-time while they're at uni or studying and working in hospitality, or your backpackers that might come and spend 12 months working around Australia and travelling. So those are the sorts of people that have filled some of those hospitality roles historically, and they are not there at the moment. So yeah, the greatest challenge for a lot of the operators at the moment is staffing rather than attracting customers. So that's a big challenge. But we have a couple of key partnerships at BankSA with both the TICSA and the AHA, and from talking to those sorts of groups, where we think that the industry is going to do very well for the foreseeable future.
Absolutely. Thanks for that insight, Andrew. And yeah, like we said, our latest barometer report did feed that back, that 70% of respondents identified that, the forecast is extremely confident for their 3 months, but also their 12-month outlook. So that is really positive sentiment for the industry ahead for us, and particularly the next 12 months. But I think one of the important points I take away from hearing both yourself, Andrew, talk, and that great data that Pat shared is, and I might indulge myself in quoting some words from our chairman, Owen Loftus, but, with the current tourism boom and the demand domestically, it sort of created a bit of lack of urgency for operators to fight back against the rising costs. But now's the time to start to address that, as we've got a solid outlook for demand and strong business conditions. Now's the time to address that, so you are in good position once that softening of the market does start to impact as we potentially move into 2024. So yeah, that would be my key takeaway. And like Pat said, some of those, those initiatives would be off the back of strong demand, pay down debt where you can. Thank you, Andrew. I'm going to hand over to David Brown, Corporate Partnerships Manager with BankSA, just to have a quick moment to chat to you on our partnership with BankSA with TICSA, and our offer there for all our members as well.
Terrific. Thanks very much,
David.
Fabulous. Thanks very much, Kathy. Really appreciate it. I suppose a couple of things from me just in wrapping up. First of all, thank you very, very much to everybody for joining Pat, Andrew and myself today. Really appreciate you taking some time out of your day. As a priority, because it's really important, a huge thanks to Sean, Kathy and Finn for giving us this opportunity to provide you with our outlook on SA's economy and how our outlook is expected to impact your business. For those of you who may not be aware, BankSA has a special home loan offer that is available for TICSA members and their employees. And how it works is this: because you're a TICSA member or an employee of a TICSA member, BankSA will give you a $1,000 cashback when you either purchase or refinance your home loan direct to BankSA. And when it comes to refinancing, this $1,000 is in addition to any other offers that are available in the market by BankSA at the time. So BankSA right now has got a $4,000 cashback for refinances, but because you're a TICSA member, call it $5,000, 4 + 1. So if you wander into any branch, identify yourself as a TICSA member or an employee of a TICSA member, our home finance manager will then apply a special code to ensure that you receive the cashbacks you're entitled to. I sent through all my details on the chat line. Email address is david.brownie, BROWNIE @banksa.com.au, or mobile 0466 404 074. And that's probably it from me. Kathy, thanks very much again.
Great. Thank you, David, and thanks for sharing details on that fabulous offer. As we talk about paying down debt, it doesn't just apply for commercial, it applies for personal too, as we get ourselves in good stead to manage the headwinds that we're going to face moving into the next couple of years. So I want to put it out to the floor there. I can ask questions to Andrew and Pat, but I want to put it out there to the floor, to the community, because you know, it's really important to make the most of the resources we have on the call today. Does anybody have any questions for Pat or Andrew on the phone, on the session today? Feel free to use the chat function. Okay. Oh, thanks, Sarah, for saying thank you. I'll put it out to both yourself and Pat, Andrew and Pat, sorry. You've obviously said we can try and reduce debt. If I'm a small business owner, what else can I do to help combat and prepare myself for these rising costs? You know, who would you be recommending to speak to, or some small quick actions I should be looking at internally at my business?
Well, I suppose, you know, one of the things with the operating costs is, you know, negotiating the best you can with your contracts, whether it's you know, supply of electricity, energy, those sorts of things. So you know, just making sure that you're getting the best deal available with those suppliers.
Yeah, absolutely. That's a good tip. Always continue to look at not necessarily maximizing profit, but, you know, looking at how you can reduce your expenditures by renegotiating contracts with suppliers. Pat, any other things, anything else you wanted to add to that?
No, I think that's kind of your main ones, right? Your kind of overheads, your capital expenses. So if you're managing that by paying down debt, you know, managing, reducing your overheads as much as possible by renegotiating contracts. I think you're kind of, you know, you're preparing for what's to come. Yeah, I think that's kind of your kind of main ones there. Definitely.
Yes, thank you, Pat. Well, I think, you know, my key sum up to round up today's session, and I really appreciate the insight that you've provided, Pat, and then your expertise as well, Andrew, is, you know, we have got strong business conditions, and that is forecasted. Our sentiment survey backs that up. But like Pat said, we've got some headwinds coming towards us, some significant headwinds. So now's the time to prepare from that. And it's not about trying to increase profit from trying to drive additional revenue. Let's try and focus on, you know, contracts and procedures and processes, and put some really good control methods into place to help work on those expenditures that could be coming through, and combat that rising inflationary impact to goods and services as well. Well, I'll leave it here. We have no more further questions that have come through. Just a few thank you. So once again, thank you, everybody. Andrew, Pat, David, for sharing your time and expertise today. I know I've taken away some really good insights, and I'm sure our members have learned and have got a little bit more intel on what they should be focusing on in their business over the next couple of months as we prepare for what's to come ahead of us. After today's session, we will be sending out an email which has a link to the recording, as well as the offer David mentioned, and all call to action as well. Thank you, everybody, for participating, and we look forward to continuing to support our industry as we move through 2023 and into 2024, and we will continue to provide you with these great economic updates from BankSA as well. Thank you all.
Thanks, Kathy. Thanks, everybody. Bye.
Thank you.